Good day. We're recording this webinar and we'll share the link with all attendees. And I know some of you have already asked questions, and you can also submit questions into the Q&A pop-up at the bottom of your screen. Now, today, I would like to discuss how you can do better in managing risk using ECRI's cyclical framework. And we'll answer as many questions as we can at the end, depending on time. Now, in doing so, in discussing this framework, we're going to cover a couple of current examples, including cycles in US economic growth and also global industrial growth. Now, during the discussion, we're going to touch upon something that is not very well known, namely that the information that most everyone watches to get a read on the economy and where we are really doesn't have that much predictive value. And you could do a lot better looking forward. If you think about it, the way that most people have been monitoring the economy, certainly over the past year and a half, is through narratives around the pandemic, supply chains, and even politics. And essentially reacting to all sorts of perceived event risk. In contrast, as we're going to discuss today, our framework on monitoring many cycles gives us far greater foresight, allowing us to anticipate the direction of the economy without being jerked around by all these shifting narratives. And so it's our unique understanding of these cyclical dynamics, which is embedded in what we're calling the ECRI framework, the ECRI many cycles framework, which allows us in working with our clients to have them proactively navigate key cycles like US economic growth or even global industrial growth. Now, ECRI's founder was a man named Jeffrey H. Moore, and he has been called the father of leading indicators because more than half a century ago, he developed the original leading index of leading economic indicators. And that, everybody knows about it. They say the words leading index. Okay. But what most people don't know is just how much progress we have made in monitoring economic cycles in the subsequent decades. So much so, we now know that US recessions are literally just the tip of the iceberg in managing cycle risk. And as a result, ECRI's analytical framework, which is shown here, includes the active monitoring of many cycles. But now they're primarily within three key aspects of the economy that we're showing here. Cycles in economic growth are shown in green or depicted by the color green. And then separately, inflation cycles, and it's a distinctly separate cycle in red. And then also another key aspect is cycles in employment, shown in blue. And within each of these dimensions, economic dimensions, we drill down into cyclically distinct aspects and sectors of the economy. For example, like non-financial services, where most people actually work, or home price, cycles in home price inflation. Now, part of the progress we've made over the decades is in extending our cyclical analysis to cover now 22 market-oriented economies around the world, including all the major developed and developing countries. And importantly, our framework accommodates, these international cyclical linkages that are really critical to take into account, especially nowadays. So within this framework, let's look at one aspect that is generally viewed as central to decision-making, namely cycles in US domestic economic growth. Now that's the highlighted, I'm just orienting you. That's the highlighted part of the framework shown here, and that depicts overall domestic economic growth, in this case, the US. It's just one facet of the cyclical prism we're monitoring on the US economy and economic activity. Uh, there's also inflation and jobs. And this is just one economy. We're doing the same thing for 22 others. So for cycles in economic growth, US economic growth, specifically, we're talking about accelerations and decelerations in overall US economic growth. And this is defined by our coincident index, the US coincident index shown here, which includes measures of aggregate output, employment, income, and sales. And to be clear, coincident index growth is not a forecast. It is rather, it's the target. And it summarizes the hard data on actual economic growth outside your window. Now, in this instance, we're showing the smooth growth rate with the orange shaded areas marking off periods of economic deceleration that we call growth rate cycle downturns. And you can see on either side of the chart, two big recessions bookending this period. On the left-hand side, you have the Great Recession of 07, 09, and on the right-hand side of the chart, you have the COVID recession with the blue line really jerking down in 2020. And the shaded areas are showing the growth rate cycle downturns in between those big recessions. Now, this is important because swings in earnings growth are tied to the economic cycle. Slowdowns and accelerations have significant consequences in terms of risk and opportunity for both investors and also business managers. And this is why growth rate cycle upturns and downturns have really important implications for stock prices, share prices. Now, our work shows that if you want to manage, or as you try to manage equity market risk, it's important to understand that major corrections, double-digit percentage declines in the S&P, are linked to growth rate cycle downturns in the economy. And, sure, smaller, like 5% or so, stock price pullbacks are almost always possible. But the much bigger drops are unlikely unless or until an economic slowdown arrives. And please note, on this chart, we're showing what we've seen in the so-called QE era following the global financial crisis. Now, before QE, before this chart, there was a very good correspondence between growth rate cycle downturns and cyclical downturns and share prices, stock prices. And in those instances, you would see a very persistent decline in stock prices lasting several months, rather than in the QE era where it might last for weeks instead of months. And in the pre-QE era, a lot of these downturns would actually end with bear markets. Nevertheless, growth rate cycle downturns remain high-risk periods where major stock price correction risk is concentrated. And that's what you see on this chart. And on the flip side, you also see on this chart that growth rate cycle upturns, the white areas, have been low-risk periods for share prices, and they're pretty much devoid of such corrections. So to better understand the risk of a correction now, today, it's really helpful to know how we navigated the slowdown and related market correction that followed the initial rebound from the Great Recession, the left-hand side of this chart. So within our many cycles approach that I described earlier, our monitoring of overall U.S. economic growth prospects and where we are in the cycle includes the sequential system of indexes shown here. And it begins with the long leading index growth, and that's shown at the top of the chart, and it's designed to turn first. Weekly leading and short leading index growth, the second and third lines, are intended, the way that they fit into the framework is they're providing confirmation of the earlier signal. before coincident index growth, the bottom line, the target, the actual economy, finally turns. And please recall that even after the recession ended in June of '09, there was intense skepticism about the recovery that extended at least through the late fall of '09. Remember, in early '09, it was like, is it a depression? That's what the talk was. So it took a while for sentiment to flip. Now, when it flipped, people really started pounding the table on a V-shaped recovery. We are owed a very strong and the implication was sustained recovery. But as you see on the chart, by December of '09, our analysis started to foreshadow an upcoming peak in growth, and that was in stark contrast to the growing optimism around a V-shaped recovery. And so we began preparing our clients for this, variant scenario, a very different directional view at the time. Now, we actively are monitoring these and other leading indexes, weekly, monthly, ongoing basis, a lot of data coming in with our clients in real time. And so by March of 2010, we knew that the upcoming slowdown was getting pretty close. And by late April of 2010, stock prices actually started to slip. And in May, we confirmed to our clients who had already been forewarned that the growth rate cycle downturn was indeed getting underway. It wasn't a forecast, it was like under our feet. And so here we've seen what happened last time there was a slowdown following the initial recovery from recession. And right there, when I say stocks slipped in April of 2010, they fell double digits, percentage point decline. And so following this initial recovery from recession, let's look at what's going on now, because we see what happened after the financial crisis. Now, yes, the current cycle has broken all sorts of records. In the early spring of 2021, coming off the big fiscal package, the stimulus checks, the economy was riding high, no doubt. And coincident index growth, you could see at the bottom there, was at nearly 20%, right? That's output, employment, income, and sales, the growth rate of that. So, but what we're seeing here is that by May, our long leading index was clearly signaling that the drivers of the cycle had rolled over, right? So even though the coincident index is shooting up, that long leading index is saying the cyclical drivers have rolled over. And so we knew the rising risk of slowing growth needed to become an active feature of our client discussions, despite these really crazy numbers to the upside. And by June, we had clear confirmation that even with the reopening, the slowdown was, in our words, baked in the cake. And by July, we confirmed that wasn't even a forecast anymore. The growth rate cycle's downturn was already underway. And now, the point of all this is that our framework enables us to have the discussions necessary, not under duress, to help build conviction about why the cycle is turning the other way. Because you're really going to need that conviction if you're going to kind of go against the crowd, against the headlines. And now today, the S&P is around its highs after earlier having slipped a bit. And many stocks underneath have actually done a little worse than the headlines. Okay. And this is pretty much in line with the cyclical relationship between stock price corrections and growth rate cycle downturns that I showed earlier. Sometimes the the reaction in stock prices happens a little faster, sometimes a little slower as the growth rate cycle slowdown uh, takes hold. Um, and because the current growth rate cycle downturn is not over, downside risks to stocks remain heightened. That's the simplest way to put it. And meanwhile, the bond market seems to have at least initially priced in the prospect of a cyclical slowdown, and you saw that very much in real rates coming down. Yet so far, inflation expectations have remained elevated, and so now we've taken a quick look at cycles in overall U.S. economic growth. But another key aspect of their framework is not limited to this, right? Even though this is a far cry from what the leading index was half a century ago. We're also going to take a look at another key aspect of our framework that speaks to a true global cycle, the global industrial cycle. And it's related to the highlighted parts of our framework shown here. We're looking at the manufacturing, the industrial sector of the overall economy and at commodity price inflation. And we're aggregating this for all 22 economies that we actively monitor. So yeah, the G7, yes, China, all of those are in there. And when you add up industrial production globally, this is what it looks like. It's a chart of cycles in global industrial production growth. And the shaded areas are marking off periods of rising and falling growth. The orange shaded is the cyclical downturn. And, clients find it very helpful to know when this cycle's changing direction, because it's like the biggest backdrop of the global risk on, risk off tone. And also because, not just because of that, but also because cycles in global industrial growth are linked to industrial company earnings, as you may imagine, and they're linked to industrial commodity price inflation. And here we're showing the growth rate of ECRI's industrial price index, or the IPI, and that's made up of 18 sensitive commodity prices. And you can see IPI growth tracks the cycle pretty closely. It's the downswings are linked to the downswings in global industrial growth and vice versa. And despite the banner headlines that you've seen on some commodities, here's the reality, is that industrial commodity price inflation has very clearly turned down from strong readings. And in contrast, it was just a few months ago, 3 months ago, that the global manufacturing PMIs ticked down for the very first time, right? Not very prescient. And here we're showing on the top line the global PMI against, and the bottom line is the same hard data that you saw earlier on global industrial production growth. And you could see that the PMI, which is soft data, doesn't have that much predictive value, meaning that is the turn happening before the shaded areas switch. And the global PMI basically turns around the same time as industrial growth. And in the latest episode, in the 2021 downticks, the PMI actually lagged. It wasn't leading at all. And a lot of people watch the PMIs, right? They're like, what's going on with growth? Let's watch the PMIs. And unlike the PMIs, our framework actually does give advance warning, even in really weird moments, or supposedly weird moments like now. So within our many cycles approach, I had touched on at the outset, our monitoring of global industrial cycles includes, here's another sequential system of indexes. And at the top of the chart It begins with the Global Industrial Growth Long Leading Index, or GIGLY, and it's designed to turn first. It has a very long lead. It turned down well before the current slowdown in the hard data started. And the Global Industrial Growth Short Leading Index, or GIGSLY, the middle line, is next to turn down, confirms, again, the confirmation idea that we're closing in on the peak in industrial growth. It helps tighten up. Like, we get prepared with the long leading index that tightens it up and brings it into focus with the shorter leading index. And the bottom line shows actual global industrial production growth, and that's already begun to turn down. Again, we're actively monitoring all of this in real time, so we're able to see really how that evolves for our clients. And again, the point is to have the room, the evidence, the framework to build conviction ahead of the turn, because you're going to need that. That's what you need to go against the crowd, which again is going to be focused on, some commodity price jerking around, or the PMIs. So it's another example of how we kind of help our clients outperform, kind of see the signal for the noise. Now, in December of 2020, looking at this, we saw storm clouds on the horizon, but we knew that the global industrial upswing that we had totally nailed earlier, by the way, was poised to persist for a few more months. And so we said, hey, you can still make hay. You just have to think about this down the road, these storm clouds on the horizon. And in March of 2021, we saw that things had really started to dim in our shorter leading indicators, and we shifted the tone in our client discussions around these storm clouds getting closer to shore. And by May, we knew that the slowdown on global industrial growth was already at hand. It was beginning. The mounting risk on commodity price inflation and on the PMIs that everybody's focused on turning down, right? So we knew, hey, everybody's looking at that, and that's going to start to falter. So again, you get a sense for how working with us and our clients using this framework, what it felt like, and what we were up to with them. So this dialogue is really the feature of how we work with clients as we approach turning points, in this case on the downside, but likewise on the upside. And we've seen this movie before. It may seem like ancient history, but you had a big downturn, global industrial downturn in 2014-15. It's still relatively recent, and we nailed it before it became obvious again to the PMI data. In November of 13, we made our downturn call. It's marked off by the red vertical line. That downturn 14-15, was so widely missed that years later, the Times, New York Times, was compelled to write this, big feature article calling it the most important, least noticed economic event of the decade. And they went on to theorize that this U.S. manufacturing recession, in essence, was responsible for that whole political earthquake in 2016. We saw it coming. And by 15, our research, by 2015, our research showed that the bottom in global industrial growth was already in sight. Okay, so by the spring of 17, we having seen the whole upswing, we foresaw the coming peak in global industrial growth. Again, well ahead of the consensus, which is just focused on the PMI or whatever the headlines are. And of course, back in May of 2020, we had a super timely global industrial upturn call. And in that score, it seems clear, 2020 hindsight and all that, but we never wavered. I mean, we were really clear, regardless of the obsession around the pandemic or political risk, about what was going on cyclically. So that's worth a lot, like that hard conviction. Now, we've talked about ECRI's overall framework. We've looked at a couple of examples of that framework, and how we work with clients to navigate those cycle turns, uh, both on US economic growth and on global industrial growth cycles. And before we turn to Q&A, I try to get in a few questions here. I want to make one more observation. In the wake of the COVID recession, right, as we're trying to get our bearings, uh, there's been a lot of focus, growing focus, especially from the big consulting firms, on the need for companies to become more agile to deal with so-called black swan events. And first and foremost, just on the face of it, that's a reactive strategy. And I'm not saying you shouldn't have some agility. That okay, but to be clear, most alleged black swans are actually linked to predictable cyclical turning points. And from the vantage point of this framework we've discussed today, that linkage underscores the importance of anticipating directional changes in the cycle. That's proactive, right? And probably in the end a bit less expensive, almost certainly less expensive than a big consulting effort to increase your reactive agility. Now, with that, let's turn and take a couple of questions. Um, okay, how is the outlook for the current global industrial cycle likely to surprise investors' expectations regarding a strong economy and rising inflation? And what is the timing of this? And as we've just seen, the slowdown is already showing up in commodity price inflation, regardless of those headlines that you're seeing on supply constraints or whatnot kicking up a few prices here and there. There is a pronounced, pervasive, and persistent decline in commodity in sensitive industrial materials price inflation underway. And our cycles framework has really nailed the ongoing cyclical upswing in overall inflation, and earlier it got overall growth. So the underlying issue, or any perceived tension from cycles appearing to go in kind of different directions, I think really comes from not understanding that many cycles are at play. And there are times when some of these bigger cycles, growth or inflation, can seemingly go in different directions. And that's not, that's not a bug, it's a feature. That's the way the world works. That's the way cycles work. And our framework really acknowledges and embraces that. Another question is, how will this play into the risk of a correction in the stock market and the direction of rates, interest rates, market calls? So ECRI doesn't make market calls, but it does. The stuff is related to market prices. Showed you the chart earlier that the risk of double-digit declines in stocks really spikes up around downturns in overall in growth rate cycle downturns. Volatility spikes up there. So that's the environment we're in right now. We made that call public a little, not too long ago. The risk of corrections has risen sharply. And, on rates, I mean, the way, there's real rates and there's inflation expectations. And so, we've made the growth rate cycle downturn call weighs on real rates, and the inflation component, there's cross currents there right now. And I'll leave it at that for now. Another question: while the global industrial rate of growth may be moderating in the future, do you see it reverting to a sustainable growth rate? And this is a kind of an interesting conceptual question. We don't see a lot of evidence of kind of an equilibrium growth in market-oriented economies. We see more evidence of these endogenous cycles, accelerations and decelerations. They will swing up and down. And sometimes the swings are big, sometimes they're smaller, like the amplitudes can change. But that cyclicality, that feature, again, it's a feature, it's not a bug. That's really how that's the environment we're in. And so while we don't get too much into magnitude, we're like a laser beam on when the direction and growth will change. And that is the primary value added from working with us. Now, another question. There may be many cross currents on the inflation front. Okay. We have high money growth that may remain historically high, along with supply issues on the commodity front. How does your view on industrial growth correlate with where our inflation expectations should be going over the next couple of years? Okay. But, this is the big inflation debate. What's going to happen over the next couple of years? The sum total of our research shows that it might not have been determined yet, let alone even knowable, right? Because of we're in such a highly complex system with a lot of nonlinear dynamics at play, and we're extremely sensitive to initial conditions. So it's hard to know. Okay, for years out. But we may not even have to know. A very good thing to do, in our view, is to monitor the evolution of the inflation cycle dynamics, the red area of our framework, and that's precisely what our future inflation gauge was designed to do. We did a webinar on this a couple of months ago. If you email Melinda@businesscycle.com, she can send you the link to that. It gets into the whole discussion of inflation cycles are separate, and what do you do about that, and what have we been doing about it? And it's the future inflation gauge is one piece of analysis that we use on inflation cycle risk. So is it going to be transitory or not? Are we going to see a run up like we saw in the 70s? Perhaps, right? I mean, not like the 70s. I don't think we're going to get average inflation that high, but we can get, average inflation can probably bump up from where it was in recent years. But I don't even know that you have to buy into a viewpoint. I think that's our point. If you know what the cyclical outlook is, then that's a huge step up from the confusion that abounds out there around inflation. And our cyclical outlook is good for several quarters. And so, and if things are going to change, the framework warns you about that. That's what the whole design is. Before CPI inflation moves, okay, or the PCE deflator or whatever, the FIG is completely agnostic to all these headlines. And it is focused like a laser beam on the future direction of the inflation cycle. Some of you who are watching may remember Alan Abelson from Barron's, who's since passed away, and he wrote a column up and down Wall Street, and he liked the FIG, and he, I think, gave us one of these compliments. He said the FIG is an unnapping watchdog, unquote, on inflation. And so we're watching that closely right now. There's a little bit of stuff going on now. I think we've run our course. We're running out of time. If I didn't get to your question, just please email us and we'll get back to you and answer your questions, any questions that come in as quickly as we can. You can email pro@businesscycle.com. And thank you for taking the time to listen. Appreciate it. Bye-bye.